Reset sequence activated. 3, 2, 1.
Is this your homework, Larry?
Ask him about the car, man.
Is this yours, Larry? Is this your homework, Larry?
Is that your car out front?
Is this your homework, Larry?
We know it's his fucking homework. Where's the fucking money, you little brat?
This first lesson in chapter 5 is mostly going to be about market cycles, but we are going to briefly go over some psychology of market cycles, just so you can kind of understand that, you know, if you are a retail trader in this game, especially if you're trading with smaller accounts, you are basically the prey in a market of predators. So if you can understand this and if you can learn to trade with the big boys and girls, then you may stand a chance. But trading is extraordinarily difficult, and finding an edge can be pretty difficult, and it requires a lot of discipline and a lot of patience and a lot of command of your own personal psychology. So market psychology is the idea that movements of a market reflect or are influenced by the emotional state of its participants. It is one of the main topics of behavioral economics, an interdisciplinary field that investigates the various factors that precede economic decisions. So basically, when a market goes up, it's likely due to improving attitude and coincidence among traders. Now, a positive market sentiment causes demand to increase and supply to decrease, therefore putting the price up. In turn, the increased demand may cause an even stronger attitude. Similarly, a strong downtrend tends to create a negative sentiment that reduces demand and increases the available supply, therefore sending the prices lower. Okay, so market psychology really is the idea that the movements of a market reflect or are influenced by the emotional state of its participants. That's one of the main topics in behavioral economics. Again, that's an interdisciplinary field that investigates these various factors that are accounted for, that really play a big role in economic decisions and market behavior. Okay, so we've all heard of market bubbles, and many of us know someone who may or may not have been caught in one. Although there are plenty of lessons to be learned from past bubbles, market participants still get sucked in each time a new one comes around. Now, a bubble is only one of several market phases, and to avoid being caught off guard, it is essential to know what these phases are. So an understanding of how markets work and a good grasp of technical analysis can help you recognize these market cycles. So this is one thing I firmly believe, and I hope I've been able to kind of convey that in this course, that if you understand the market forces that are moving the price, it makes your technical analysis that much easier, so you understand why patterns are being formed, and what the push and pull, if you will, really is behind why prices are rising and falling. So there are basically 4 market cycles. That's it. You have your accumulation, your markup, your distribution, and your markdown. As you may have guessed, accumulation is when things are just moving sideways, pretty boring, no one's really interested in the market. Markup phase, prices start rising, people start getting interested. Distribution, it's when people start piling in. When you're retail, when your friends call you, hey man, I'm thinking about getting into Bitcoin. Should I buy Bitcoin? Should I buy Ethereum? Should I buy Dogecoin? That's usually when we're near the distribution stage and prices are getting ready to head to the downside, because the ones really in charge of the market, meaning those who have the most interest financially in the market, are getting ready to take profits on the poor suckers that bought in at a higher price. All right, so basically the accumulation phase is when the market has bottomed. Early adopters and contrarians seek an opportunity to jump in and scoop up discounts. This is followed by the markup phase. The market phase seems to have leveled out, and the early majority are jumping back in while the smart money is starting to cash out. Distribution phase, sentiment turns mixed to slightly bearish, prices are choppy, sellers prevail, and the end of the rally is near. And then finally, we have the markdown phase, where laggards try to sell and salvage what they can, while early adopters look for signs of a bottom so they can get back in. Now, the whole idea of understanding technical analysis and trading in this market is to avoid buying high and selling low. And if you can understand the market psychology behind why most traders actually end up doing this, you may just have a chance at becoming successful. All right, so the accumulation phase, again, it occurs after the market has bottomed. However, in the accumulation phase, prices have flattened, and for every seller throwing in the towel, someone is there to pick it up at a healthy discount. Overall market sentiment begins to switch from negative to neutral. So again, you can see the way this diagram looks here on the bottom of the PDF, just a bunch of sideways consolidation, usually right before prices start moving back again to the upside. Then we have the markup phase. So at this stage, the market has been stable for a while and is beginning to move higher. The early majority are getting on the bandwagon. This group includes technicians who, seeing the market is putting in higher lows and higher highs, recognize market direction and sentiment has changed. At this phase begins to come to an end, the late majority jump in and market volumes begin to increase substantially. At this point, the greater fool theory prevails, valuations climb well beyond historic norms, and logic and reason take a backseat to greed. While the late majority are getting in the smart money and insiders are unloading and cashing out. Then we have the distribution phase. So at this phase, again, it is when the holders who got in during the accumulation phase start to unload their bags onto the retail or the dumb money. And, you still may even have some FOMOing in here at the top. It's the third phase. And then when this phase is over, the market reverses direction. So classic patterns like double and triple tops, as well as head and shoulders, are examples of movements that occur during the distribution phase. Now, the distribution phase is a very emotional time for the markets, as investors are gripped by periods of complete fear, interspersed with hope and even greed, as the market may at times be appearing to take off yet again. And then we have the final phase, the markdown phase. The fourth and final phase of this cycle is the most painful for those who still hold their positions. Many hang on because their investment has fallen below what they paid for, behaving like the pirate who falls overboard, clutching a bar of gold, refusing to let go in vain, only hopes of being rescued. Now, it is only when the market has plunged about 50% or more, then the laggards, many of whom brought in during the distribution or early markdown phases, give up or they finally capitulate. Now, unfortunately, this is a buy signal for early innovators and a sign that the bottom is imminent. But alas, it is new investors who will buy the depreciated investment during the next accumulation phase and enjoy the next markup. So there is a trader who is very famous, Mr. Wyckoff, who published an entire concept and theory on how these market cycles work. So after you get a firm grasp of technical analysis and start to really kind of get an intuitive feel on how these markets really move, I really highly recommend studying the Wyckoff Method. So Wyckoff's chart-based methodology rests on three fundamental laws that affect many aspects of analysis. These include determining the market's and individual stocks' current and potential future directional bias, selecting the best stocks to trade long or short, identifying the readiness of a stock to leave a trading range, and projecting price targets in a trend from a stock's behavior in a trading range. These laws inform the analysis of every chart and the selection of every stock to trade. Okay, so the law of supply and demand determines the price action. Now, this principle is central to Wyckoff's method of trading and investing. When demand is greater than supply, prices rise. It's pretty simple. And when supply is greater than demand, prices fall. The trader analyst can study the balance between supply and demand by comparing price and volume bars over time. This law is deceptively simple, but learning to accurately evaluate supply and demand on bar charts, as well as understanding the implications of supply and demand patterns, really takes a considerable amount of practice. Okay, the law of cause and effect helps the trader and investor set price objectives by gauging the potential extent of a trend emerging from a trading range. Now, Wyckoff's cause can be measured by the horizontal point count in a point and figure chart, while the effect is the distance price moves corresponding to the point count. Now, this law's operation can be seen as the force of accumulation or distribution within a trading range, as well as how this force works itself out in a subsequent trend or movement up or down. Now, point and figure charts counts are used to measure a cause and project the extent of its effect. So the law of effort versus result provides an early warning of a possible change in trend in the near future. So we talked about divergences, and here they are again. So divergences between volume and price often signal a change in the direction of a price trend. For example, when there are several high volume, large effort, but narrow range price bars after a substantial rally, with the price falling to make a new high, little or no result, this suggests that big interests are unloading shares in anticipation of a change in trend. Okay. Again, you have to remember that, the little guys are the prey in this market. So they are feeding on your predictable psychology. So market cycle timing is very important, right? So you want to be able to get in during the accumulation phase. So a cycle can last anywhere from a few weeks to a number of years, depending really on the market in question and the time horizon in which you're looking. And you can see these market cycles play out across all time frames on the chart. So a day trader uses 5-minute bars, may see 4 more complete cycles per day, while a real estate investor, a cycle may last, 18 to 20 years. So most traders and investors agree that psychology has an impact on market prices and cycles. And although the psychology of market cycles is well known, they are not always easy to deal with. So from the Dutch tulip mania in the 1600s, I'm sure you're familiar with this story, to the dot-com bubble in the 90s, even skilled traders have struggled to separate their own attitude from the overall market sentiment. Now, investors face the difficult task of understanding not only the market psychology, but also their own psychology and how that is affecting their decision-making process.